Is it okay now? All right. So when it comes to budgeting and control, um, there are many parts that are involved in this topic, right? Normally, if you see, um, you have the traditional budgeting part, right? So there you have the methods of budgeting, why budgeting, pros and cons of various budgeting techniques such as fixed and flexible incremental, zero-based, rolling, activity-based budgeting. Now, if you look at activity-based budgeting, there's a little bit of theory at the lower levels, but at APM level, you can get calculations, right? Then they have also brought in the variance part into APM, right? Mainly now, if you look at variance, advanced variances, you have mix and yield, planning and operating, isn't it? Sales mix and quantity. But what is normally tested here is planning and operating, right? So you should know how the calculation works. Then only we will be able to comment on it. Plus the implications, the theoretical part. So that also we should be able to have. Then the non-budgetary methods. So basically, the other side of budgeting, right? Beyond budgeting, okay, this area focuses on why budgeting is bad, the negatives of budgeting. Normally, the problem is what the moment you put a budget, your mind is set on it, irrespective of what happens in the environment, isn't it? So if the environment is, let's say, moving rapidly, whereas your budget is on a moderate level, you still want to stay at a moderate level because of the budget. But then that is not enough to fit into the environment. So those are the aspects that is, spoken on beyond budgeting, right? Then a little bit on participation, top down versus bottom up, right? Um, so when it comes to theory, like I always say, be very thorough, right? But what can be tricky is the calculations. All right. Right. Start off, I have shared this question with you. I'll give you a couple of minutes. Can you quickly read through this? I shared this question on your WhatsApp group as well. All right, guys. So what I have done is I have taken down the initial information for the two divisions, right, which we will need it for the second part. So let's look at the first part, right? Normally, when it comes to budgeting with multiple divisions, this is how they test it, right? Either they will bring in ABC or ABB or rolling, right? But there will be multiple divisions because each division will have to follow a different type of a budgeting system depending on their characteristics. So that's why I just got down the individual characteristics of these two divisions, right? So let's see how it goes. Right now, the first one, using the data in appendices, recalculate the current year budget to the end of the current year and briefly comment on the overall impact of this on the expected operating profit of the year. So now they have already done the current year budget, isn't it? um, they want you to redo, right? And in Appendix 2, they have given you expected key costs and revenues for remainder of the current year. So we have to incorporate this, right, into this budget and reproduce and say, okay, finally, what will be the profit? Now, as per what is given in Appendix 1, the final net profit is going to, operating profit is going to be 1,240, right? So if we include these amendments, adjustments, what will be the final profit? Okay, so let's do this. You can start. Right. So we need to start with Q1, right? We need to start with Q1 figures. Because in rolling, remember we we can either use budget or actual, but to be more realistic, we can use the actual and roll it, or bring in the factors that are affecting your budget and adjust it accordingly, right? So let's adjust one by one and bring it to our calculation. Okay. So let's do the revenue first. So the revenue, they say volumes are expected to be 2% higher each quarter, right? And then selling price per unit is expected to increase by 1.5%. So both are increasing. Volume is going up by 2.5%, rather 2%, and price is going to increase by 1.5%. So let's include both. Yeah, I'll give you 2 minutes. Complete the cells. Shown the volume increase. Price increase, how do we take? On what do we take the price increase? Now, price increase will impact not only your, the existing volume, but also what? The increase in volume. Price increase you have to take together. All right. So, for example, quarter to 12,000 plus 240, right? Of that 1.5%, which is the 0.015. Sorry, starting from quarter three, right? The price increase. Yeah. Those aspects you need to pay attention, now. So the final revenue figure that you will take your calculation is this. So quarter two revenue is going to be 12,240. Quarter three revenue is going to be 11,388. Quarter four revenue is going to be 7,247. And the total of that 41,275. So this is how you bring each one of the number or the element to your final calculation. Right now, do the cost of sales. Right, let's do the cost of sales figure. If any of you have done it, can you please share it with me? If any of you have done it, please share the answer with me. Cost of sales has two impact. Definitely see. Now, this is where you need to pay attention. Now. Okay. Cost of sales will depend on revenue, isn't it? Now, here we increase the volumes by 2%. So then that volume impact will also be there for cost of sales. I mean, you can't sell what you don't have now. To sell the 2% additional, you need to manufacture that, isn't it? Then your cost of sales will increase. Then they're also talking about the exchange rate. That is what a lot of students found it a bit difficult to tackle. I'll explain it to you. Okay, let's fix the volume percentage first. From quarter to 2% here, 0.02. Right. Any of you have the exchange rate impact? How do we bring the exchange rate here? They said the exchange rate between C dollar and the V dollar is predicted to change at the beginning of quarter two to $1 by to 150 V. For several years up to the end of quarter one has been equivalent to 1.40. So what was 1.40 is now 1.5. And this exchange rate has been used when producing the current year budget. So they have used 1.4 to prepare the current year budget that is given to us. Food produced in the luxury division is dispatched immediately upon production, and F holds minimal inventory. The cost of ingredients imported from VLAN represents 50% of the division's cost of sales, and suppliers invoice goods in V dollar. So this impact is only for 50%, isn't it? Because only 50% of the ingredients are imported. So then obviously exchange rate will impact that 50%. Right? Okay, how do we tackle this here? I'll give you 2 minutes quickly. The exchange rate. How much do we put? Very good, Sagar. There is an exchange gain, correct. Why? Because if you look at the rate, okay, let me read it for you again. $1 buys $1.5. So 1 is to 1.5, right? Now it is 1 is to 1.4. Sorry, what was 1.1 is to 1.4 has now changed to 1 is to 1.5, right? So the amount of money you pay will what? Come down, right? Because your currency is strengthening, right? Because your currency is strengthening. So it's good for the importer. So there is an exchange gain, which means your cost of sales, that part of the element will come down by that figure. So how much is the question now? So we can find out a small percentage impact for overall cost of sales and then apply to that. Okay. So what was 1.4 is now 1.5, right? So what is the net impact? 1 minus 1.4 divided by 1.5. Take it as a percentage. 6.67%. So the reduction we need to apply for 50% of the cost of sales, not for the whole thing, right? 50% of the cost of sales. Right? So how it will apply is this is your total cost of sales, right? Of that 6.67 divided by 2. Why? 50%. The cost of sales plus the volume increase. So we take the total 7120 plus 142. Apply the exchange rate percentage and divide it by 2. Why? Because cost of sales, the impact is only on 50% of the ingredients which are imported. Now in APM, like I always say, it's not difficult, the calculation, but they can be a little complicated, So you need to figure out how to sort this out. Then you drag the equation. And this you have to take it as a positive figure because as an exchange rate. These are minor things that we need to pay attention to, right? So now you can bring these figure to the top. Right, I hope you guys are clear with the cost of sale. We arrive at the GP. Done. Next we move to distribution. To four. Right. The rate of tax levied by the Sri Lankan government on the cost of fuel, which luxury uses to power its fleet of vehicle, is due to increase from 60%, which it has been for many years, to 63% at the end of the beginning of quarter three. So the impact is going to come from quarter three. 70% of the division's distribution costs are represented by the cost of fuel for delivery vehicles. Right? 70% of the division's distribution costs are represented by the cost of fuel for delivery vehicles. So that change is applicable only for 70%. Now, this is another one where a lot of students got confused, right? Because of the way they have worded it. I have one question for you. What is the increase in tax percentage? Can you tell me that? What is the increase in tax percentage? Think and tell me. Anyone who can tell me the tax percentage? Increase in tax is 3%. Correct. Right? Increase in tax is only 3%. What was 60? Okay. What was 60 has now become 63. Okay. Now, don't go to at the 3%. Okay. Don't go to at the 3%. Listen to this carefully. Because inside this distribution cost, you have already factored in the 60%, isn't it? Inside the distribution cost, the 60% is already there. Cost plus tax, no, whatever the cost on that 60% tax. So you have cost plus tax. Now the question is the 3% addition, how do we bring in? The 3% addition, how do we bring into this distribution cost? Because 60% is already there inside that. We need to bring in only the 3%. Right, let's put the sales volume increase 2% first. If where it impacts the 2%. Now the full tax increase is applicable from quarter 3 and quarter 4, isn't it? But I'm asking you, what is the percentage? How much do we take in? How do we take it? Right, look here. 3% increase from 60 or 160. 3% increase is from 60 or 160. Exactly. It will be from 160. 160 is cost plus tax. Because in our existing cost element, 100% of the distribution cost plus the 60% tax, which is 160. AK tamai, you have another 3% increase, right? But that is applicable for 70% of the distribution cost, not for the whole. So we need to get that also right. So the actual increase is 1.31%. The net effect is 1.31%. So that you apply to quarter 3 and quarter 4. 1.2. For this figure, you will plug it to distribution. Right, then finally admin. Admin, I don't think it will be difficult. We have 2496. What do they say about admin? TO has initiated a program of overhead cost reductions and savings of 2.5% of the budgeted administration cost are expected from the beginning of quarter two. Quarter three administration costs are expected to be a further 2.5% reduction lower than quarter two, with a further 2.5% saving in quarter four over the quarter three. So, year on year, rather quarter, every quarter, they're expecting a 2.5% saving from the previous year figure. Quickly finish that up. And if you look at admin, it's a constant figure, isn't it? 2,300. Saving 2.5%, which is compound. Into 0.025. So for quarter two, I have 2%, 2.5% saving from quarter one. I'd complete the rest of the years and tell me the figure. I mean, rest of the quarters, quarter three, quarter four. Can I have the quarter three figure? So quarter three is going to be this quarter two saving plus what you will be saving at the end of quarter two into 0.025. Check the equation. Yeah. So quarter 250, 2.5% plus from the previous year. And same thing will apply to the quarter four. This. Right, so this is your final answer. Quarter one, okay, already given. Quarter two is 2243. Quarter three is 2150. Quarter four is 23. In total is 1660. Now, if you look at the sum, their total profit is 4,000, isn't it? As per the sum, the original budget they prepared gives you a profit of 4,000. Whereas our recalculation shows 5660. So what is the increase? 5660 divided by 4,000 is 41% increase. Right, so you can put a 1 minus. Right, so it's 41% increase, which is more realistic, right? Because the key point here to make is you have made the changes based on current market conditions and factoring in the effects of various, exchange rate changes, fuel cost increase, taxation. Now, this is a better budget to rely on than what was already prepared. So that is the final comment that you need to make. All clear? Any questions? Any questions, guys? Right. Let's go to the B part. Evaluate whether a move from traditional incremental budgeting to a system of rolling budget would be appropriate for dairy and luxury divisions. 13 marks. Right. Now, this is why I took down the notes from the scenario so that it's easy for us to quickly make that decision. Okay. They're asking, right, evaluate whether a move from incremental budgeting to a rolling system would be appropriate for dairy and luxury. So incremental to rolling. Now, what is incremental budgeting? Take last year's actual or budget, add a percentage for future budget. This add a percentage is either for inflation and expected, growth and things like that. And if you foresee that the economy is going to, contract or, go through a decline, then you reduce a percentage, right? That is incremental. Take last year's actual or budget, increase or reduce a percentage depending on how your cost and inflation is going to move, right? Now, what is rolling budget? When a particular month or quarter is over, based on what happened in that month or quarter, we forecast for the next month or quarter. So it keeps on rolling. For example, let's say you have initially prepared a budget for 4 quarters, right? Q1, Q2, Q3, and Q4. So this is what we initially prepared. Now Q1 is over. Okay. Q1 is over. So now we have only Q2, Q3, Q4 budget. To this existing budget, what we do is we go and add another quarter, Q1 of the next year. For example, this is 2024. 2024, quarter 1 is over now. Isn't it? Quarter 1 is over. So I'll remove that to make it easy. So in 2024 budget, we have only 3 quarters now. To this, we go and add another quarter, Q1. But the Q1 we add based on what happened during this period. So this Q1 will relate to 2025. Okay, then Q2 of 2024 is over. We remove that. And then we go and add the Q2 for 2025. So the biggest advantage is at any given time, you have one full year's budget. So forecasting, budgeting is not a one-time exercise. It's a continuous exercise, which will make managers be more aware of what is happening in the environment, and hence they can come up with more realistic budgets. That's the biggest advantage in rolling. Now the question is whether rolling and incremental are good for dairy and luxury, right? Whether rolling and incremental are good for dairy and luxury. Now, if you look at dairy, they are producing cheese and milk. Saturated market. Now, what is a saturated market? If you take the product life cycle, right? You have introduction, growth, maturity, decline. Now, this maturity and saturation are here, right? Meaning product has reached the maximum market potential. I mean, okay, in Sri Lanka, we have 22 million population, right? Even if one person buys 2 SIM, you can sell 44 million, no, not beyond that, isn't it? Including the children then, whereas we can't. So saturation is the point where you have entirely reached the market, right? So product is now stagnant in terms of sales. Okay. Little opportunity for growth, obviously, isn't it? Unless, of course, there's a special order of foreign customer, we are not going to sell much. Little opportunity for growth. Fixed price contracts for 3 years. Now you have, for example, with supermarkets, right? contracts to supply to them your cheese and milk, but for a fixed price. That means for the next 3 years, you know what your revenue is going to be, isn't it? For the next 3 years, you know what your revenue is going to be, right? Because you can't change the price. You already agreed, contract. Fixed volume and price contract with suppliers. Meaning what? Suppliers means what? Your input, your cost of sales. There also you have what? Agreed what the cost is going to be and what the volumes are going to be. Obviously, right? Now see, when you fix your revenue, you know what the quantity is going to be, Then for that quantity, you agree with the supplier, right? So that way you are reducing the uncertainties that can come up in the market. Now, these are things that you need to write in the answer. Delivery subcontracted. Now you have subcontracted the delivery also. Someone else outsource, delivery. And if there are fuel increases and everything, maximum they can increase is 0.5%, which is okay. So the variability is quite less, right? And you have an efficient production facility, meaning your wastage, your losses, normal losses, all that can be what? Very, very minimal. Or you can even assume that it is not there. Now, these are all what you need to write. After that, you need to say whether dairy should follow incremental or rolling. What can you tell me? Because of all these reasons, dairy should follow incremental budgeting or rolling budget. Exactly, incremental. Because their growth is very, very minimal, isn't it? And pretty much everything is fixed. There's no major changes to bring in. Then you conclude by saying, due to the above reasons, incremental budgeting is suitable. Even if you put one and a half line, you will get a mark. So it's 13 marks. So 6 and 7 or 7 and 6, right? So you need to give 6 or many number of points describing what is happening and then conclude. Yeah, unless any discretionary cost, you can even mention that. But in a saturated market, yeah, it's going to be very less, isn't it? Discretionary cost. I mean, in a question like this, you are tempted to write a lot. So be careful. Okay. Stick to the content, save time, move to the next one. Right. Next, luxury. A new division, 2 years. New division. What does that mean? They're here, in the growth page. Right? You won't know what the demand is. You won't know what kind of quantity that you need to produce. You will not know how the market is going to move. Right? High quality products. High quality products. Price is going to be high. High quality products means you need good ingredients. No? So these ingredients are rare and expensive. Big trouble. Rare means price is going to be high. Right? Rare will also put another problem. What if you don't get the material? So you need to have substitutes, isn't it? Then imported, another issue. Therefore, depending on the exchange rate fluctuations, the input cost of these raw materials will also fluctuate. And these guys are using their own distribution fleet. Then price changes on fuel will impact them. For dairy, it's a maximum of 0.5% cap. Whereas luxury, we don't know. It will depend on the market. Luxury is highly volatile. That's a conclusion you should make. Therefore, what kind of budgeting do we do for luxury? New division, lot of unknown factors, lot of fluctuations in costing. Therefore, what do we do? We go with rolling, right? Exactly. So that's the conclusion that you need to make. All right. Any questions? Do we need to tell if we continue in incremental in luxury? Do we need to tell if we continue in incremental in luxury? Disadvantages. Yes. Automatically you're talking about it, isn't it? When you write the answer, you're automatically saying um, we can't just go incremental because the cost elements are not increasing in a increasing percentage. It highly varies. It's volatile, right? So ideal is based on what is happening in the current market conditions. So that's what you must say. Right. In terms of budgeting, try to get hold of more questions and do it, right? It's going to be the same format or the pattern, right? That will apply. Right. Let's look at another one, which is fixed and flexible. Let me share the question with you. You have to use an Excel to do this, so then it becomes easy. Otherwise, there's too much work. I'll give you 5 minutes to read it. All right, guys. This question, why I chose is one thing, it tests your, the calculation part. The other thing, it has some good, questions on testing your thinking ability, right? Especially question B, C, D, right? Um, you need to be a little bit more, looking outside, right, to answer these. E, of course, the usual, right? You will, like I always say, most of the time you will get a question on KPIs, right? Performance management. Um, I mean, for you to do performance management, you need what? Performance indicators, right? The major area that I'm interested in is BCD. But before that, let's quickly finish the actual and budget, right? Start doing it. Use an Excel, then it's easy for you to put the equations and complete it. Revenue private fee paying patients and revenue government fee paying patients. You know, through, right? Fill this column. Sum. You need to figure out the patient days. Okay. You need to figure out the patient days. Look at the last two lines just before the requirement. Each hospital is comprised of 15 wards, each of which can accommodate 8 patients. The average patient stay in both hospitals was 3 days. Each hospital is open for 365 days per annum. So 15, 8, 3, 365, right? Patient days. 15 into 8. But average stay is 3 days. Isn't it? Now this should be multiplied by 365. Right? So this is how you get the patient days. Okay. Can you tell me how many that is? What is the figure there? What is the value? How much is that? 15 watts. Each can accommodate 8 patients, but each patient stays about 3 days. So 15 into 8 divided by 3, average. And they open for 365 days. 14,600, correct, right? Now, 14,600 is the total, which has to be divided among N2 based on private and government fee paying patients. But this is the total figure. 14,600 is the total capacity available. Now, here we are talking about fixed and flexible budget. To flex this, what percentage do we take? That is also given in the sum. Look at point number 7. Point number 7 in the question. Other statistics relating to West Hamburg. Let me share it with you. Look at this. Other statistics related to West Hamburg. Capacity utilization is 80%. So from 14,600, you take 80%. Right? Then that figure, you put it between 75 and 25. And actual will become 35, 30, 35. But budget is 30, 30, 40. Then it will be easy. You flex it at the beginning rather than individually flexing the figures. All right. So 14,600 into 0.8. 11,680. It is this figure that you claim, not 14,600. All right. Now you can put the revenue here. All right, guys, let's quickly finish this off. So we need to get the revenue for budget and actual. Um, but within budget and actual, the fee paid by private patients, that is patients who are directly coming and they look after their own expenses, and the fee paid by the government on behalf of the patients are different. Okay, right? If you look at the budgeted distribution among ENT, it is 30-30-40. And if you look at the actual distribution among ENT, it is 35-30-35, right? And government fee paying patients are 75%, and private fee paying patients are 25%. All right. Government fee paying patients are 75%, and private fee paying patients are 25%. So using these numbers, now we need to work out the figures, right? Right. The first one, look at this. I've taken 11,680. Okay. Of that, 0.75 is government fee paying patients, right? For the budget. Huh? Then 30% of them is year E, and they are paying 2,000 each. Okay. And now then we can just follow this equation. And make a T. And 5. The P is increasing by just 1,000, isn't it? 2, 3, 4. Or rather, yeah. For government, 2, 3, 4. For private, it is 3, 4, 5. Comes 40%, becomes 4. Right. What is the others? sorry. Right, any of you have the answer? Any of you have the answer, please? To the revenue part? Right. Um, Once again, let me explain it to you. The government fee paying patients will pay 2,000, 3,000, and 4,000, whereas private fee paying patients will pay 3,000, 4,000, and 5,000. Budget distribution is 30, 30, 40. Actual distribution is 35, 30, 35. Right? When they prepared the budget, they assumed 50% of patients will be funded by the government and 50% of patients will be funded by the private, fee paying patients. And government patients, in terms of actual, is 75%. So that means actually 75% of the patients were funded by the government, and only 25% of the patients were private fee paying patients. So now we need to bring that here into this calculation. All right. So let's do the actual first. 11,680 into private fee paying patients. Can someone quickly give me the figure? What would be the answer there? Yes, correct. 3060. 11,680 into 0.35, which is the actual, right? And in actual, 25% of the fee was paid by the private fee paying patients. And how much did they pay? 3,000 each. So 3066. So in each of these equations, we need to change only two elements. One is the fee and the other one is the percentage. Nose becomes 30, fee becomes 4. 35, 35, and 5. Now finish the government this part. So revenue from the government for actual, again 11,680. Actual is 0.35 for a year, right? But the actually government fee paying patients is 75%. And they will pay 2,000 each. So 0.75 into 2. So L5.30 multiplied by 3. 5.30 multiplied by 5. Those are the figures for revenue on the actual. Now quickly finish the budget. Level 680 into 0.3. Budget is 30% per year. And 50% of the patients are fee paying by the government. And they will pay 3 each. %40. No? Four. Right. So those are the revenue figure. But that is of course not complicated because its distribution is 50-50. Actually, only you need to pay attention now because it's 75-25. I think rest is very direct. Next is variable cost. Let me take this line out so that I have a bit more space. So variable cost, we have surgery, nursing, and sundry. So if you can see the question, they have given it to you separately, right? Variable surgery, surgical, nursing, and sundry, and then the fixed. The actuals are given, so we can take those as it is. Let me put the actual first because budget we need to flex. Eight two eight four triple two four triple one six. I'm taking it directly from the question, no? And then the fixed. Surgical nursing, depreciation, administration, and funding. $26,550, 5,600, 1,007, 342, 4912. Now, budgeted figures, when it comes to budget, you need to flex a little. How much do we put for variable cost? Surgical. What would be the figure? What would be the figure for surgical? Budgeted cost for the year based on 100% capacity they have given in point number 3. Look at that and tell me. Right, look at this. Surgical, they have given us 35,400 total cost. Right? Variable element is 25%, 0.25. 35,400 budget, 25% variable is based on 100% capacity. Right? It's based on 100% capacity. So now we need to flex it to 80% because our capacity utilization is only 80%. So 0.8. So 7,080. All right. That's how you get the 7,080. Same way, nursing, 8,000 into 30% into 0.3 into 0.8. That is 1,920. And sundry, 5,750 into 20%. 5,750 into 20% into 0.8. That is 920. So the rest you can bring it for actuals, right? For the fixed, 26,550, 5,600. Depreciation is entirely applicable. Administration is 3,250. Sundry is 4,600. Right, apply the percentages and bring it in. So that's all, nothing else to adjust. So let's get the total revenue. And then the total cost. Net profit. Budget is negative 9572. Actually, we have made a bigger loss than the budget, 15,838. Right. Let me move to the second part. Explain 4 reasons why it may be inappropriate to make a direct comparison of the financial performance of the West Amber and East Green hospitals on the basis of the information provided. Right. So they have also given you information about a privately owned hospital. Isn't it? Asking why you can't compare the two directly. Okay. Why you can't compare the two. I'll just say why we can't compare the two hospitals directly. Can you quickly give me some answers? What are the 4 reasons? One is the funding. Okay, you can explain and write it. Okay, I have some finance. Yeah, okay, funding. One hospital is entirely private funded. So there are shareholders or owners, they will want a return. Whereas government, it's more of a service, isn't it? So one is conference, not for profit. The other one is for profit, right? So that also you can write separately. So funding is one, the way it gets funded. Therefore, your capital structure, okay, funding, capital structure. Sagar, that's how you can begin your interest part. Then one is for profit. Other one is not for profit. I mean, both will have two different ways of management, isn't it? A lot of things will differ there. Then another point is your revenue stream. A private hospital is what? I mean, it's entirely a private fee-paying patients. Whereas in a hospital like this, West Amber, you have government fee funding patients also. The problem there is government fee-paying patients. The revenue is low. You are not getting the full amount, isn't it? So that's the issue there. Any other you can say? Any other you can highlight? The private hospital versus government. Any other you can say? A private hospital can say, um, we will stop operations, right? They can decide whether to serve a customer or not. Of course, it will impact their reputation. But in a government setup, it's going to be quite serious, isn't it? Right? What else can we think? You can actually talk about a lot. What else can you say? Now, in a government hospital, service will be provided at any cost, right? Your cost of sales. Whereas in a private hospital, you will be more, be really, really efficient, isn't it? Because you will want to improve your margins. You will not want to, compromise on that. So apart from that, you can talk about service level, quality of care, right? Availability of resources. So a lot of things in terms of service provisions will be there, but then try to touch on the financials, because the question is very specific on the financials. Okay. Why you can't make a direct comparison of the financial performance? Right. Okay. Now the third part is what I'm very interested in. Right. Let me share that question. Right. The third part. Using only information contained in the question, make the adjustment to the income statement you have prepared in your answer to it that you consider would assist in the development of an appropriate comparison of the financial performance of Western India. Right? Now they're asking you to make the adjustments to the profit figure we have calculated. Okay. So that your comparison is more meaningful. Right? That your comparison is more meaningful. So let's see how to do this. So these are the profit figures that we have. With actual is 15838. Budget is 9572 and is 2000. I'll give you 2 minutes. Can you think of what needs to be done here? So they're asking you to make the adjustments, right, to these figures so that the final results is more comparable, right? Three adjustments, 1, 2, 3. We can call it adjusted profit. I'll do one for you. If you look at East, right, it's entirely private funded, isn't it? It's entirely private funded. And in their P&L, the summary, they have a loan interest of 500, isn't it? Loan interest of 500. West is entirely government funded. Okay, West is entirely government funded. So here we assume East is also fully equity funded. Because in a government funded hospital, you won't have interest. So East also we assume there's no interest. So what we do is we add back 500. Okay, we add back the 500. So that adjustment is done. We got another tool. I'll tell you what it is. It's the revenue adjustment. Because in East, we don't have government fee paying patients. We only have private fee paying patients. But in the West, there is a portion which is funded by the government. You have to assume that part is also private fee paying patients. If that is the case, what is the amount? If that is the case, what is the amount? Fee adjustment. How much do we take for actual and how much do we take for budget? If you look at the fee adjustment for budget, 11,618. Of that, 50% of the patients are what? Government fee paying patients. And all of them, whatever surgery percentage, are paying 1,000 difference, isn't it? For year, they are paying 2,000, whereas private fee paying patient is paying 3,000. So 2, 3, 3, 4, and 4, 5. So at each level, there's 1,000 difference. So we need to bring that 1,000 into our calculation. 11,680, the total patients. Of that, half is government funded. We are assuming they are private fee paying patients. That means our revenue will increase by another 1,000 for all of that patients. So that amount is 5,840. Okay, 5,840. Let me put one here. So can you get the decimals? Right. Same thing. Actual. In actual, government funded patients, 75%. So 11,680 into 0.75 into 1. That is 8,760. We are assuming all are paying the private fee. And finally, if you look at the East Hospital income statement, they don't have emergency operations, isn't it? They don't have emergency operations. Whereas our government setup, we have emergency. If you look at point number 3, it says variable surgical cost include a total amount of 1 million in respect of operations undertaken on emergency basis. And under actual, it says 800,000 of variable surgical costs related to the provision of emergency operation. So under budget, we got to take 1,000, and under actual, we have to take 800 emergency. These are the three adjustments we have to make. Now, these profits are comparable. You can make a conclusion saying, after we adjust, right, for loan interest, fee, and then the emergency, the resulting adjusted profit figure is comparable, right? Of course, it is not 100% comparable, but some effort towards the comparison. And on that basis, still East is doing a better job, right? But then we don't know how many patients they looked after and all that, isn't it? So you can say, to make a proper comparison, you need the number of employees, the number of patients, the fee they pay, all that need to be looked at, right? Because they haven't given those kind of big breakdowns here. So on a higher level, this comparison is okay. Right. Number 4. Discuss the statement of West Ham's recently qualified accountant, including comment on the ethical implications of the statement. Now, what is he saying? Let me share this with you. These are important questions, huh? Especially covering ethics and operations and performance. Here you go. Number 6. A recently qualified accountant, right, employed by West, has stated that it is obvious that the mix of government to private patients mix is the key determinant of profitability. Is correct, isn't it? Obvious that mix of government to private patients mix is the key determinant of profitability. Meaning, if there is more private patients, then their revenue is more, which will impact their profit. Next year, it looks as if demand for total operations will exceed our available capacity, and therefore, we should give priority to private fee-paying patients as we receive more fees from them for each type of operation. It is as simple as that, since there aren't any ethical issues to be considered. It is as simple as that, since there aren't any ethical issues to be considered. Okay, I'll give you 3 minutes. Can you give me 2 lines of an answer for this? First of all, is the statement correct? And what is the ethical implication? Is it ethically also correct? Just give me 2 lines. Anyone? Yeah, so what you will say here is, right, is, comment in terms of revenue would be increased if the private fee paying patients are increased is correct. Okay, he's absolutely spot on there. You have to mention that. Okay, he's correct to say that um, hospitals' revenue can be increased if they focus more on the private fee paying patients, right? But can the hospital do that? No, because there is an ethical issue. Because this is funded entirely by the government. Okay, it's a government funded hospital. And more importantly, what you need to highlight is the mission statement of the government. What does it say? The hospital is committed to providing high quality health care to all patients. Understand? It should be, highlighted. All patients. All patient means what? Private plus government. You can't take a particular side because of a reason. In this case, the fee paid by the private patients are high. We can't take that into consideration. Also, government funding means the government is not making money. No, it is taxpayers' money, isn't it? Those people who are funded by the government, they are also paying an indirect tax. They may not be paying a direct tax because their income levels are low. So they are paying an indirect tax. So for that, they also need to get what? The public service, the benefit. So that is the line on which you argue. His statement is correct, but ethically we can't do that because one is it's government funded. Mission statement is to consider all patients. Number three, tax, right? Right, the final part, excluding the number of complaints. Okay, excluding the number of complaints, it's four performance methods that may be used in order to assess the surgical quality provided by a hospital, indicating how each mission may be assessed. Surgical quality. It's not to assess the performance of the hospital, but to assess the performance of surgical quality. I'll give you 2 minutes. Quickly give me four thoughts. Guys, any answers? Excluding number of complaints by patients, state 4 performance measures that may be used in order to assess the surgical quality. 4 performance measures. Right. You can say number one, time spent waiting for operations. Okay. Basically, someone coming and booking for an operation, and how long do they have to wait? I mean, typical scenario in the government hospital, isn't it? Some people even will die waiting for too long. Number two, surgical quality, right? Number of successful operations compared to the total performed, right? Number of successful operations done compared to the total performed. More the merrier, right? Then you can also talk about hygiene, cleanliness, right? Which you can measure through observation, right? Which you can measure through observation. And maybe in comparison to a, standard, something like ISO or, SLS, right? So hygiene and cleanliness. Another one would be staff patient ratio, right? Staff patient ratio, like a teacher to student ratio. Similarly, staff patient ratio. And another one would be responsiveness of staff to request of patients, isn't it? Someone comes and asks for assistance, then how responsive are they? You know how it happens in government hospitals, right? They go and tell you, go and take a seat, and you will probably be sitting there for hours and hours without any support. All right. So these are some of the measures. So any alternative suitable measures you can suggest. All right. Right. Now let's look at a few transfer pricing questions. Okay. Now in the class, I have done good questions on transfer pricing. Okay. So those cover the main areas, but I'm going to do few more here, short ones, to recap your knowledge and tackle a few calculation elements. Right. Let me share the questions with you first. And in terms of transfer pricing, remember the general rules and the practical methods. Okay. Remember the general rules and the practical methods. I'll quickly recap. What are the general rules? Number one, if you are selling a product that belongs to the perfect market, right? Then the ideal transfer price is market price. Now, in transfer pricing, it's all about trying to achieve the characteristics of good transfer pricing. It's about fairness, achieving goal congruence, trying to reduce, international tax liabilities, enable easy bookkeeping, right? You need to look at all those aspects. So fairness is a key element of transfer pricing, meaning between the buyer and the seller, where both will be internal divisions. So transferring and the buying division, right, should have fairness. That's the key thing. Okay. So under general rule, number one, perfect market product is being transferred. So then the ideal transfer price is market price. Number two, if there's surplus capacity, okay, meaning you're producing more than the demand, more than the requirement, and that additional is needed by your other division, right? So then the ideal transfer price is variable cost, because supplying division will not go below the variable cost. Because if they go below variable cost, they'll end up making a negative contribution. A negative contribution is not good, right? So again, to maintain fairness, minimum acceptable is what? Variable cost, right? Then opposite of surplus, deficit. Supplying division has deficit capacity. That means they don't have enough. So now what do we do in this instance? Now, supplying division does not have enough capacity, and the internal division is asking for some of those goods. So by that, the supplying division is losing the opportunity to sell it outside. So whatever they're losing outside, they can charge from the internal divisions. So that is considered fair, right? So those are the three main generic rules. Then we come to the practical elements, right? Number one, perfect market, yeah, fine, no problem. A perfect market price, no problem. But whatever the cost you save in an internal transfer, you must deduct. For example, packaging, labeling, advertisement, sometimes transport. If you're in the same location, you don't need to transport. All that cost you are saving. So deduct that from your market price and then transfer internally, because you both have to work together to achieve the ultimate goal of the organization, goal congruence. So market price minus cost saved, you arrive at the adjusted market price. Okay. Then number two, if you have surplus capacity, you're transferring at variable cost, isn't it? But you have a fixed cost also to cover, isn't it? So you can charge that fixed cost in two ways from the buyer. Number one, dual pricing, where the seller will record one price, buyer will record another price. Seller will, for example, record it a higher price. Let's say the cost is 80 variable cost, but he will record it at 100. So he has a 20, margin to cover the fixed cost. But buyer will record it at 80. So 100 seller is recording, buyer is recording it at 80. But when you do consolidation, the 20 will pop out, isn't it? That you write it off. Okay. Because it's an internal company transaction. No. Number two, two-part tariff. Two-part tariff. So initially you charge the variable cost. Two-part tariff means two elements, right? Two charges. So initially you charge the variable cost. Later, you charge a lump sum to cover your fixed cost. Later, you charge your lump sum to cover your fixed cost. So end of the day, you're charging your total cost. So that means it will be fair by the selling division also. All right. So these rules you need to carefully look into when you're doing a transfer pricing sum. Without knowing these rules, you cannot attempt transfer pricing questions. Remember that. Some must that you know this. Okay. The sums that I have done in class, consider all of this, right? Normally, that's how they give two divisions. One is this, one is that, like the budget question we did, right? How should they go about? How do we maintain fairness among these two, right? So for that, you need to know all the rules. Without knowing the rules, it's not going to work. Right now, let me share some questions with you. All right, I just shared a question on your WhatsApp. Can you please get me the answer for that first? Is anyone with the answer? It's a very simple one. Okay, Amina says 10.5. Sagar says 6.5. Um, so division A is selling to the external market at 12. Variable cost is 8. Fixed cost is 3. So that's fine, and then there's a margin. Charge it says 10.5. Okay. Market demand for this exchange division, yeah, that's fine. Division B would like to obtain 500 units of product A from A. If division A does transfer some of its production internally rather than sell externally, then the saving in packaging cost would be 1.5. What transfer price unit should per unit should division A quote in order to maximize group profit? Yeah, 10.5 is correct. 12 minus 1.5. So, that is the adjusted market price. 10 minus, sorry, 12 minus 1.5. Right, let me share the next one with you. Just now, what I just shared. Any of you have an answer for this? Using an opportunity cost approach to transfer pricing, what is the minimum transfer price to transfer X? Any of you have the answer, guys? It's very simple. I mean, instead of selling, right? Instead of selling Y, now you need to make X. Sajid, no. Instead of selling Y, you need to make X. So whatever you're losing from Y, you need to recover from X. Right? So let's see. As a division, right? Division Y, I mean, division A supplying Y, whatever you're losing by not selling Y, you need to recover from X. Haridhan. So first thing, variable cost of X is how much? 270. That is 150 plus 150 plus 120. Then you also need to get the opportunity cost, or you can say lot contribution, right? Whatever. How much? Very simple. For each unit of Y, okay, for each unit of Y, you are making a contribution of 600 minus 280. We don't take apportioned fixed overheads into this calculation. Nah? Apportionment can be anything. So that is not relevant here in transfer pricing. 320. Isn't it? 320 is the contribution. Right? The same rate of materials and labor is used in both products. The cost cards for each product are shown below. Now see, um, look at labor. For Y you need 4 hours, right? 80 divided by 20. For X you need 6 hours, 120 divided by 20. So 4 into 20 is 80, 6 into 20 is 120. So labor hours 4. So what is the contribution per labor hour? 320 divided by 4, which is 80. Neither. We'll put all this in one. Per hour, you're losing 80 because now that's what you need to put for X. No. So for X, you need how many hours? 6 into 80. So that you need to recover from, I mean, whatever you are losing, you need to recover from X. So 480. Minimum transfer price 270 plus 480. 750. 750. That is the minimum transfer price. Yeah, got it? Right, next one. Tell me the answer for this. Read and tell me the answer for this. Think and tell me which one is correct. You need to justify your answer. Tell me, guys, which one is correct and why? Rajesh, which one is correct? Opportunity cost B. So, I mean, are you saying it's statement number two? Yeah, correct. Right. Now look at this. They say company is yeah, no spare capacity. If they don't have enough spare capacity, that means they have enough demand outside, isn't it? Right? Uh, Amina, read the question again. Now listen now. Division B, if a company makes units which are then transferred to other divisions. Division has no capacity. See how tricky it becomes, huh? The following statements have been made regarding the minimum transfer price that will encourage the divisional manager of B to transfer units to other divisions. Now look at statement number two. The division will need to give up a unit sold externally in order to make a transfer. Correct. You need to give up externally to do an internal transfer. This is only worthwhile if the income of a transfer is greater than the net income of an external sale. Question is division B selling externally? Exactly. No. Division B makes units which are then transferred to other divisions only. There is no talk about external sales. So then this is not applicable. Now let's look at number one. Any price above variable cost will generate a positive contribution. Correct. Anything above variable cost is your contribution and will therefore be accepted. Yes. Because at this level, at this statement level, this is correct. Of course, any amount above variable cost should also cover their fixed cost. Okay, but we don't have that level of detail here. So at this statement level, statement number one is correct. So answer is only statement one, not two. So that's why reading the question is very important. All right, I got one more for you. Yeah, quickly do this now. This is a very easy one, right? How much? 22.5. 22.5. Come on. Internal transfer. PM has sufficient capacity to meet all of the internal and external sales. The objective is to maximize group profit. Guys, selling price 24. CS 40%. If you have enough capacity to take care of internal as well as external sales, right? The external sale you will be anyway selling, no. By transferring internally, you're not losing. Right? By transferring internally, you're not losing. Right? By transferring internally, you're not losing any of your external sale. Your cost is what? 24 into 0.4. Sorry, 0.6. Huh? 24 into 0.6. 14.4. And you can avoid a variable cost of 1.5. So 14.4 minus 1.5. 12.9 is the answer. So you have to think carefully. Yeah? Understood? So in transfer pricing, guys, these are the things. They will sneak in 1, 2 words here and there to make it more complex. So if they say by transferring internally they can't meet external demand, yes, then you are right. Then you have to deduct only what you're saving. But here there's enough capacity, isn't it? So by transferring externally, you're not losing anything internally. And internally, to maximize group profit, you should go with the minimum. Then only the group profit will be maximized. Are you clear? You guys okay? Right. So with that, let me conclude the session. So next week also we'll do some more questions and I will share the areas by Monday. Okay. And in the meantime, please do revision questions and if there's any questions, let me know. You're welcome. Thank you guys. Have a good rest of the weekend. Bye.